Greetings, friends. Hello, everyone. Dan Fasciano here. I'll be your host for today's event. I'm coming to you live from Studio 301 here in Swampscott, Mass. Great to have a lot of friends joining us. I saw the roster in advance. So the title for today's session is going to be Earning Investors' Trust, Enduring Times of Uncertainty. And mercifully, I get to play the role that I enjoy most, that is host and moderator. And I'm joined by three guests, one a longtime friend, both of mine and of CFA Boston, and I've got some new friends. I mean, great members of CFA Society Boston, but newer friends for me. Let me just kind of lay out the format for you. In a perfect world, I'm hoping to end somewhere around 1:15. We'll see how it goes. But we really put our heads together and said, how can we make this most interesting for everyone? And a lot of credit to my co-presenters today. We really kind of got together, particularly Rebecca, and said, let's kind of change things up as we're going along and try to keep it fresh and engaging. So just to set expectations, we're focusing on the most recent trust paper produced by the CFA Institute, and we're really thankful to have Rebecca Fender here to walk us through that. I mean, she's just been an engine for so much of that great activity at the Institute, and my experience with her has gone back more than 10 years. So I'm just thankful to have her here. But when we were planning this session, we said, well, why don't we have Rebecca start by an overview, the whys and the hows and the content of it, and really update you. For those of you that have been familiar with the work on trust, Rebecca's here again to kind of tell you a little bit about some of the highlights from the most recent findings. But she'll do that. We're going to have some Q&A, of which I'll ask the questions. I do have access to a question box, so if you submit one, I'll try my darndest to make sure I work it in. We'll do that for a little bit. Then Rebecca is going to take us through some of the themes intermittently from that paper. I don't want to give away any of the content she's got here. So it's going to be a little bit of an ebb and a flow, which we're kind of excited about. There's going to be some polling questions, so you don't just get to sit there. We need you to kind of participate. The questions that we've developed hopefully will kind of inform us. So before I steer over to Rebecca, let me do some introductions for everyone on the for everyone joining us, and I'll start with Rebecca. I believe we can all see her now. I'm going to do some reading here. I've got notes all around my desk here, so I'm going to do a little bit of reading as I go my way through, and I'll add some editorial as I go. A lot of times people will say, well, geez, needs no introduction. I don't want to do that. I want to make sure that we do have some proper introductions here. So Rebecca Fender from the CFA Institute, in addition to working there, she is a charter holder, and she leads the Future of Finance Initiative. She and I go back, excuse me, I go back with her since she helped launch that initiative many years ago. It's a funny story. Someday we'll share with others about those times. It was a while back. And that's really the thought leadership platform for the CFA Institute. She and her group publish studies to help investment professionals build their careers and serve their clients more effectively. The paper, Investment Professional of the Future, was recently awarded Best Investment Industry Paper. That was last year by Savvy Investor. And prior to joining us at the Institute, and I'll tell you selfishly, I'm glad that she's part of our team. She's worked at BlackRock. She also worked at Greenwich Associates. She earned her undergraduate degree in economics from Princeton and holds her MBA from Darden. So we never let her leave Charlottesville after she finished her graduate work. So before I hand it over to Rebecca, let me introduce our other two speakers today, the folks I'm really going to try to tap into on some of these topics. Also joining Rebecca and me is Carol Jeremiah.
All right, Dan. Hi, Rebecca. Good to see you guys.
Hello, Carol. Carol is president of MFS Investment Management and head of its global distribution. She leads the firm's worldwide client-facing teams as well as product and market strategy. And throughout her 34-year career, both as a career and at MFS, loyalty always kind of strikes a chord with me. So I knew pretty quickly she and I were going to be fast friends. She has had numerous roles there, including those related to fiduciary responsibility, stewardship, and sustainability. She's been actively engaged with clients at all levels, and she really ensures that the firm builds products and services aligned with clients' needs. So when we thought about really who are the best folks to kind of join us here, Carol just hit the bill on so many dimensions. So we're excited to have Carol joining us. And then also to make sure that we kind of round out different views, joining us is Patrizio Orcioli. Hello, Patrizio.
And Rebecca, Carol, nice to see you.
Welcome. Great.
Did amazing. Don't worry about the name.
So Carolyn, thank you. Carolyn, you know, with a name like Fasciano, you think Orcioli would come easy to me. So Patrizio, a little bit about Patrizio, and then we'll hand it over to Rebecca. Patrizio is Vice President and Executive Managing Director and Co-Head of Strategy and Asset Allocation at Liberty Mutual Investments. So there, you know, and before I even dive into the formal portion of kind of what he does there and his role, you know, we really love tapping into him because in addition to having kind of a commercial awareness and serving clients directly, his role at Liberty Mutual also causes him to need to operate as an asset owner, thinking from a very kind of proprietary asset owner standpoint. So we're going to tap into Patrizio along both dimensions in a little bit, but just a little bit more about what he does at Liberty Mutual. The area he works in is really the nerve center of Liberty Mutual. The strategic asset allocation team is accountable for helping or working with the chief investment officer set portfolio strategy and asset allocation targets for total return goals, as well as working very closely with the insurance group clients. He started his career as an actuarial and financial planning consultant in Rome. So you may hear just the whiff of an accent there. And in addition to his day job, he's been a faculty member and a lecturer at BU since 2006. He also holds the CFA designation, and he's a member of CFA Society Boston. So I'm going to kind of stop with the introductions there. I'm going to shut up for a brief period of time. I'm going to hand it over to Rebecca, who is going to walk us through in the next ideally 5 minutes or so the kind of why and how and some of the findings from the most recent trust survey. And if we're lucky, she may give us a polling question, and then she'll hand it back over to me to facilitate some questions with Carol and Patrizio. So Rebecca?
Thanks, Dan. So we'll pull up a few slides here to guide us through. So thanks for joining us. And I am looking forward to telling you a few of the highlights of what we found in the trust study this time around. So it is the fourth in a series, and we have been thinking about this concept ever since 2013, really in a very broad context. I would encourage you to think about investor trust in terms of what does it take for someone to hand their money, to entrust their money over to someone else to manage. And there's a lot that's embedded in that. So we will talk about various aspects of that, but you know, you can stop and even think personally, who is it that you trust the most and why? And perhaps it's even changed a little bit in recent months. You know, who do we meet with? How do we think about relationships? Moving to a whole virtual world has some implications for trust. And just kind of funny story, when we were first going to launch this, it was right about the time that everybody was going to work from home. And throughout the presentation, or throughout the presentation and the report, the most prominent symbol was a handshake. This was the way we thought about trust, right? And I'm not even sure that we have a good substitute for it yet. But this whole move to virtual has made us think about how do we trust, how do we strengthen relationships, and also how do we deal with times of disruption together? So we will go through a few different areas. You can see here on the slide, we've got information, innovation, and influence. Those are the three sections we'll cover, and I'll just take you through the details. So first, every good CFA presentation needs to start with methodology. And so here's what we did. We worked with Greenwich Associates to survey both individual investors, we'll call them retail here, but they range in terms of their asset levels, and also institutional investors from 15 markets around the world. So you can see the distribution there. The institutional investors we're looking at, of course, pension funds, endowments, foundations, and so forth. Minimum asset size of 50 million, and again, at least 100,000 on the individual side. I will note that as we go through the materials, anytime that we are talking about a specific market or an age group, we are talking about the individual investor. We just look at the institutional investors as a group. So with that, let's cover the key themes. So this time we thought it would be interesting to think of trust in terms of concentric circles where the investor is at the center. So that end investor, and we may consider again the asset owner as an agent for them, right? So as it relates to the investor, where are the different interactions in terms of trust? So one level is with the investment firm, one is with the industry overall, and of course one is with the system itself. And so any investment professional needs to mediate all of those levels with their client. And we know that without trust in these areas, it will decrease how much people want to invest. So actually going from the outside in, we start with information and we think about the importance of information asymmetry. So as we think about the system, if you don't know enough information, you're very unlikely to trust. Right? And so we have seen that that plays out in terms of our relationships. We look a little bit more detailed here around those with an advisor versus those without an advisor and how they relate to the system. Secondly, on innovation, we're going to talk there about technology and innovation and the interaction that that has with trust. The main point here is that the use of technology, good use of technology builds trust. It builds trust in the people, not just the systems. The third level around influence, this is about how clients are looking for more control. And a couple of the ways that this plays itself out is with things like fee negotiations and trying to control after fee returns. We also see that there is more interest in customized and personalized products, and also values alignment with their investments. So those are some of the things we'll cover there. And then lastly, just to note that we have put together this trust equation where we think about the main components of trust. And I'll just give a very high level overview of that in this first section. But before we get started, I also wanted to say that one of the key questions is sort of what's the bottom line value of trust? Does this really matter? It's kind of a little bit of a vague concept, right? Hard to put numbers around. So what we realized was that this was a very helpful question that we've asked in each of the studies. Really, what does it take to hire an investment firm? So what are the most important attributes when hiring an asset manager? You can see on the retail side, the number one item has always been somebody who's trusted to act in my best interest. Again, what does it take for me to hand my money over? And you can compare that blue bar to the next bar in green, which is the ability to achieve high returns. It's almost a 2-to-1 ratio there. And of course, we still think it's important to achieve high returns, that there's an expectation for that, but it does point to the fact that there is something about trust that we need to pay attention to, even to begin conversations. I will note that actually in the US, I'll throw in a few US specific numbers, versus the 33% there, it was 42% in the US. So even more important in our market here. On the institutional side though, you will see that that trust is sort of eroding a little bit. Those numbers have been going down and we can maybe talk a little bit more about why that could be the case. One more concept here is just the idea of trust over time, and that this is an interesting industry to discuss trust because we have this relationship aspect. It's not transactional as much as this ongoing relationship. So here, the important thing to note is that we are talking about trust in things that are trustworthy, right? We do not want to give you the tricks about how to seem trustworthy, but this is about how are firms actually trustworthy? How are they narrowing that gap between the perception, that natural state of trust at the bottom left of this slide, and then what they really should be getting in terms of trust. So you can see the different steps there. As you add information, people trust more. As you engage with people over time, as you give them advice that's helpful and reasonable, and just as they have that experience, you can build trust. So important note there. And now the last thing I'm going to cover in this first section is around the trust equation. So as we go through, we'll think about what are some of the practical aspects of creating trust. And so we like to think of it in these two main building blocks of credibility and professionalism. And credibility you can think of as those sort of clear signals, the things you can see that are relatively easy to discern, right? So you see track record, of course. That shows that there is competence involved, and that's an important marker of trust. Credentials and industry codes are also good, clear ways to show that you have credibility. And we're finding increasingly that brand is a proxy for trust. So we asked a question where we said, would you rather have a trusted brand or people you can count on? And over time, brand has become more and more important. So just as a signal. Professionalism is a little more subjective, a little more nuanced. And these are really about the mindsets that, that professionals bring to their work. And so this includes client-first values. We often ask, do you think your investment firm always puts your interests first? And that was the people that say, yes, they always put my interests first. Only a quarter of institutional investors say that, and only a third of individual investors. And that hasn't changed in the last 2 years. So it doesn't matter if there's more transparency, people don't necessarily feel that there's a alignment of interest all the time. And then commitment to competency is another aspect there. We asked some questions around, would it matter to you if you knew that your investment staff working on your portfolio kept up to date, came to sessions like this and learned things? And what we found was that a large proportion said, I think those people will actually be able to provide better results, better outcomes for my portfolio. So these are some of the positive connotations around competency, and of course, it needs to be followed through. And then one last thing, just that the other side of the equation is trust and value. So we think that, again, those are inextricably linked. You can't continue to create sustainable value without trust. And these are important for the future. So with that, we're going to go ahead into our first poll. And I'm going to pull that up, I think. Hold on just one second, technology-wise. Let me, okay, here we are. So in your experience, how, if at all, has trust in the investment industry changed in the last 3 years? So has it been much higher, slightly higher, no change, slightly lower, or much lower? All right, last chance. All right. I think you should be able to see the results now. If so, Dan, it's over to you. I think we found that a slight majority said slightly lower, but not much on the extremes. Yep.
Wow. I mean, just looking at those results, I'm a little bit blown away, and I will share with the audience that neither Rebecca, nor Carol, nor Patrizio, nor I are allowed to vote. But so by kind of not by majority, most say slightly lower, if I read that properly. I'd be interested somewhere in either questions or follow-up why those who voted that way. At least it isn't markedly lower. That was a good thing, but a little surprised. So, before I kind of start just firing questions off at both Carol and Patrizio, a couple of just observations, both having done the reading and now listening to you, Rebecca. I will say, I mean, if for those of you who know me, a lot of kind of interaction with high net worth clients, I'd always say, well, what do I need to do to earn that kind of trust? What do I need to do? How do I prove it? How do I prove it? And it almost gave me some relief, the trust gap. It's, am I trustworthy? And how do I close the gap between that and the perception? It's how they, in a sense, consume my trust. That it almost brought me some relief having read through, I think, the 2018 paper it's kind of a, it must be earned and it must be perceived, that closing the trust gap and what the kind of steps are. So quick thanks to Rebecca, because in a sense it relieved me. And then, I mean, at a very kind of personal and selfish level, under professionalism, when we study the trust equation, I've felt profoundly that I'm not sure I'd want a surgeon taking a look at me, if she hadn't done any continuing ed in 30 years of any format, and I feel passionately about that in our craft, that it's important to stay true to the kind of discipline and latest teachings. And so it's nice to see that kind of manifests through. But enough of me, a couple of things. Let me start with Carol, if I could. Carol, selfishly, having kind of you in your leadership role at MFS and thinking about your evolution there, thinking specifically from the top on trust, over the last, say, and I'll let you pick 3, 5, 10 years, given what the poll said notwithstanding, have we done a better job as an industry, but as industry participants, as people, working on or investing in our trust? Should clients, or prospects trust us better? What have we done in your mind? And let me kind of continue to just push that. Are there any gaps that you're seeing? Like, are there areas that we participants we can't get out of our own way, or in your mind? Is there anything there?
Yeah, Dan, thanks for teeing it up with this question. And again, thank you to Rebecca and the CFA. I just think the work is awesome. It highlights it, and the way you summarize sort of how to get at it is so important for us to talk about. Dan, to answer your question, I would say the industry tries like hell to get at this. I have a lot of confidence that there's good intent in trying to build this trust. And I think what we've done, but there's a riddle behind this, and that's why I think we have not necessarily nailed it. And I can see why the audience said that it's less, not more. And that is what we have done, and the way Rebecca laid this out is, I think we have done so much around credibility, and what we've done around track records and scoring and measure, right? We say to ourselves, you can't manage what you can't measure, right? That's our industry motto, right? Is because we all have to hold each other accountable. And now that there's so many layers of us in between end investors and the public companies, we now have more time that we've got to spend to hold each other accountable. Well, that's great from a transparency perspective and trying to give people more information, and that there's research and a lot of homework done. The problem is translating that into the stuff that not only is harder to measure, we don't really want to talk about, and how do we ensure that the behaviors of what we're measuring actually really are aligned. And I talk to clients a lot about what my biggest fear has been in the past 5 to 10 years is the misalignment that has grown in the system. And I've spent a lot of time studying this and talking to a lot of clients and academics about this. And I think, Rebecca, you kind of summed it up at the end. The issue is that we want to build all the measurements so that we can prove or hold each other accountable. But what we're not willing to really start to talk about is the power of time and the equation of time. Trust is not built in a short period of time. And so it is about, probably, I hate to use the term, but it's the war on short-termism. We all know it. It sets every single person up to fail in the chain when we have just defaulted to short-term measurement, short-term reporting, to what is a long-term value creation solution for the people we serve, which are the end investors. And so what's happened in time and the maturity, I think, is just how do we get at not only wanting to prove and hold each other accountable, which is critical, right? Fees are being paid, people have to be held accountable, but how do we extend time horizons and the measurements to point out there are markers to longer term destinations. Let's not make the destination the marker. And that's the behavior we need to change as an industry. And we need to be honest with the end investors that as we dial up more risk and more complexity with asset allocation decisions, right? 5 times the amount of risk that's being taken today. We've got to help people understand the power of time and committing capital to create long-term value responsibly.
So Carol, I'm gonna.
We got work to do. We got work to do.
Yeah, well, I've got a page full of notes now based upon what you just said, and I want to come back to you on is there kind of a remedy, but I want to, and I will before I hand it back to Rebecca, but I want to flip to Patrizio for a moment here. Patrizio, you're an academic. You have a commercial presence in work. You're also an asset owner. You know, I'm gonna use. You know, we've had kind of not a mini crisis, but we've just come through kind of an exogenous event where that trust relationship may have been tested. You know, 2008 was a self-inflicted wound, if you will, industry and industry participants. You know, in your mind, in the time since then, have we done the hard work in order to improve that? And you can take that wherever you want. Well, I have a follow-up question to that, but what do you think we've done in the last 12 years or so? Have we done work, we in the industry?
Then I think 2008. I mean, honestly speaking, it made permanent damage on the trust, right? On the trust of the system, financial market, financial service, asset management. That was something that was so. The trust was so disrupted during the financial crisis that I think I would be it's a layup to say, did we make progress? Yes, we did. We made an enormous amount of progress since 2008, and the study proved it, right? Information, innovation, influence are all area where as asset manager and as an asset owner we have been working together to improve, right, the trust relation. So the easy answer is yes, for sure. Big progress has been made. But two things that I like to remind myself are the following. Is like, one is someone that I truly respect in the industry used to tell me all the time, look, it's very hard to earn the trust. Once you lose the trust of someone, it's even harder to earn it back, right? So much harder to earn it the second time. So we start from a place now after the 2008 crisis where it's much, much harder to earn their role back. All the trust that we lost, now we have to work twice harder than ever before to earn it back, or maybe more. So even if we made progress, I think the key here is all the progress we made are not enough. And study like this can help, right? Can help us in the industry to say what else can we do and what are the spaces when we can focus to kind of earn it back, right? Also, the second piece I like to highlight is that we kind of we had, you know, a period where return had been positive overall, right? We had a decade of positive return, not much of, you know, huge distress except like the recent past. And so in certain sense that helped both sides of the equation, asset owner, asset manager, and both on institution and retail, to kind of maybe make some progress quicker. The question though is generally uncertainty also can destroy some of that trust if that uncertainty is not fairly communicated, right? And then we can talk later on about information and how we can inform, right, the counterpart. But the point I'm trying to make is we had a period where it was easier to make progress on earning back. And so now I can connect to the question, which was a little surprise to me, but not totally a surprise, because the question was very focused on the last 3 years, right? And the 3 years, probably people now focus on probably in the last 9 months. And this level of uncertainty, right, suddenly create, you know, psychologically on both sides, this sense of, are we still, is that trust fully back? Can we fully trust? Right? Do we have a full transparency of information? But so, long story short, big progress made, a lot of still to work on to earn it back, but uncertainty will prove really if we did earn it back. And in reality, the 10 year, we didn't have a lot of uncertainty except this last 9 months to prove it.
Yeah, you know, I want to respond to that, and then I want to kind of follow up with the question I had for Carol. My follow-up to you, or my response to you, Patricia, interesting, you know, because let's face it, future is always uncertain, right? But being kind of intellectually honest about that, you know, is tricky business, you know, and when I see, you know, I didn't invent the phrase, but what is it, sometimes wrong, but never in doubt? I think there's a temptation for some people in our industry to show confidence and to show conviction when really there are moments of an uncertain path. Your point really is giving me something selfish to dwell on there about, you know, just being transparent and honest around the uncertainty, yet, you know, but having the confidence of my ability or our ability to steer through it. Thank you for that. Carol, I want to zip back to you on something. You know, I took the notes here, and you know, just talking about or the, you know, you know, just the notion around short-termism, which, you know, I can see kind of hammering. I mean, is that on us? Is that on the end user, the client? And what can we do, if anything? You don't have to solve it all now, but in your mind, what can we do to kind of educate, hold each other accountable to get away from that as best we can?
Yeah, we got to get at it, and I think that it comes in a lot of different facets, but maybe I could just give you one example from an active manager's perspective. And part of it is ourselves doing a lot of self-reflection on how we show up in the market. Because I think so much what you want to do is you don't want to come across self-serving to investors. And so what you do is you tell them what you think they want to hear with good intent. But many times it's actually not what you believe as it relates to your investment philosophy or how you're managing the money, i.e. we say we're all long-term. So one of the things that we have said for many years in all of our books, and most active managers do, there's a good reason for it. Our goal is to outperform over a full market cycle. Well, when you'd said that long ago, people had general terms of, okay, I know what a full market cycle is. The idea of what a full market cycle is has been literally thrown out the window. And nobody even wants to touch it. Because again, we want preciseness. Now we know a full market cycle might not be precise. But what we can do is say a full market cycle is peak to peak, trough to trough. What I can tell you is over the past 100 years, a full market cycle is closer to 7 to 10 years, maybe a little longer now. But the industry has anchored our attention because it's so important to measure and hold each other accountable, rightly so, has anchored around 1, 3, and 5 year returns. And in fact, most investors, we've done a lot of survey work on this, will tell you a full market cycle is greater than 7 years. Their tolerance for underperformance, though, everywhere in the world is dominated around a 3-year number. I'm not saying a 3-year number is the wrong thing. All I can tell you is the conversation is misaligned. Because if you're hiring active management, for example, for counter-cyclical skill, what you want to do is make sure that we're going against the grain at the right time. And so the conversation around on the market cycle in general, we had a conversation with our mutual fund board, and it was so healthy to bring it back to a full market cycle and how long that is, and why are we highlighting the 3-year number if that's the end goal. We had dropped that broader dialogue and we brought it back. We changed reporting to change the dialogue. Not that the reports in themselves were that important, but we even dropped the year-to-date number. We start with the 10, the 5, the 3, and the 1. They're all there. They're all important. But again, a full market cycle and talking through where we are, I think is critically important. It doesn't solve everything, but it certainly brings better understanding and transparency to the alignment of how you're actually managing the money. The last point I'll make on that is I think the industry has sort of ignored turnover or holding horizons. It's one of the best clear metrics to prove whether you're a long-term investor or whether you're committing capital for long periods of time. I'm not saying having low turnover or high holding horizons is the answer, but you need to be clear about what you are. And as you think about yourself in the investment chain, the more clear that you are, then the investor can understand the time period that you might need because of the way you're managing the money, and to be more aligned with that. Again, I think we do drive-bys over those conversations, and when I've broached this with clients, it's, you know, they want the ammunition to help their boards and to help end investors really understand the power of time, and that we're taking risk with other people's money, and we've got to have a more clear, explicit conversation around time. And I think it's healthy, and I think it builds tremendous amount of trust. It's uncomfortable sometimes.
I'll add just 1 second because I know time is going fast, but from an asset owner perspective, I can totally assure that the courage to have that conversation is what we need in the industry, right? Because we as asset owner, right, we've been a lot of this good discussion with our board, with the business executive, to try, like, you know, in order for us as a business to be successful, we can look at the performance on a quarterly basis, on a monthly, and a yearly, or even like 3 year, right? Because to your point, that's basically drive the wrong conclusion when you look about building a business, right, and be a successful business. But both sides of the equation, they have to help each other, otherwise become like a competition of, like, I can't tell a story, right, to my board, but I need the support of the asset manager, right? We discuss very often, right? We need to have aligned interests in order then to bring the same story forward.
Yeah, very good points.
And there's so much research out there that actually can make the conversation neutral so that it doesn't come across self-serving. Because ultimately there's something very ethical about having a long-term view, and people know it.
Yeah, I 100% agree. And there's a lot to that, but Patricia mentioned, I want to keep an eye on time. Great stuff, and I'm still taking notes here. Well, for those of you less familiar with the study or haven't had a chance to read the 32-page paper, I'd suggest you do. But there are 3 areas or tenets that get focused on in the paper. Rebecca is going to take them kind of, I don't want to say one by one, but just one. We're going to talk a little bit about it, then another, and then another. So, Rebecca, if you don't mind, maybe I'll hand it back to you, and you can drill down through the first of those areas.
Sounds good. So just a couple of comments here around trust in the system, trust at that information level. So this is the question that we've asked in each of the studies over time. We started out by asking, how much trust do you have in each industry? And here we used a 5-point scale. So what you find is these are people who said at 4 or 5 out of that scale that I have trust in these industries. And so there are a few things that you can see here. First, that institutional investor trust levels are much higher, on average about 15 percentage points higher. So again, we would expect that group to have more information, to know more, as they are part of the industry themselves. Trust in financial services is about 19 percentage points higher. At the same time, if we look at the relative rankings of trust, you can see that technology is toward the top on both, but it's also the only industry that has declined since 2018. So over the last couple years, in between the fieldings of these, technology's come down. But overall, you can see trust on the institutional side has decreased. Trust on the retail investor side, pretty much the same. Slight positive, but really close to the margin of error there. So we see that there are a few tiers. Again, medicine is new this year. We thought of that as another profession that should be added to the mix. So timely that we're talking about trust in medicine, trust in technology, 2 sectors, of course, that have been in the conversation a lot. And then we see that there's kind of this middle tier that finance is in, financial services in the middle, and then at the bottom, we've got government and media that pretty much hang out there. So I will note that another well-known study is the Edelman Trust Barometer. They do the same thing where they look at different industry trust levels. They look at the general population, and what we've done, of course, is just looked at investors who might know us a bit better. They also did their study with the same timing as we did. This was fielded almost a year ago, about 10 months ago, I guess. And then Edelman went back and they redid theirs after really COVID hit. So around April, they did an update. So anyone who might ask, are these still valid? I think we can look at these in terms of relative basis. And also note that it was the areas that had the most importance in terms of dealing with challenges that had the highest positive bump in trust. And so actually financial services did have a bit of a positive bump in the reactions, at least early on to the crisis. So another thing to note, of course, is how these trust levels vary by market. So especially for anybody with global operations, you may find this interesting. Really a lot of variation. The US had a decrease in trust of about 5 percentage points since 2018. The biggest drop was in Singapore, and Australia fell to the lowest trust level of any market. Of course, this was following the Hayne Royal Commission and a lot of specific inquiries into misconduct in the industry. Interestingly, as we asked those participants specifically, do you think it will help? They were even skeptical that any of the efforts taken since then would help build trust. We did see trust increase significantly in places like Brazil, Emirates, India, and Hong Kong. And also you'll note that we added a few new markets, Japan, Mexico, and South Africa. So we've got pretty good global coverage here. I will also note that we asked in the UK a few questions are related to the very public failure of the Woodford Equity Income Fund and how some things can be these challenges for the industry in terms of trust overall. How do we deal with challenges? I thought Patricio had a very good point before, like, do we get a second chance? Sometimes you find that in the difficult times, that's the chance to differentiate yourself the most, right? And so I think when we asked people, do you think your firm's well prepared to deal with a crisis? People's trust has actually gone up in that over time as there's been more opportunity to show how you deal with it. So there can be more preparedness. Now, of course, we think about trust in industries, that's kind of high level, but what about the people themselves, right? We're interested in what do you think about financial advisors, financial professionals. And so here we did a little different metric where we said, who do you trust the most? So anyone that was rated high, ranked, 1 or 2 out of these 6 categories is in the blue there. And you can see again, doctors far and away the most trusted, politicians far and away the least trusted, and financial advisors right next to mechanics. So it was a little bit different by market. In the US, that 77% for doctors was 86%, so even higher. Almost 60% said were positive on accountants, 25% on financial advisors, only 11% for lawyers, and 1% for politicians. So that's where we stack up in that regard. And but then there's an important differentiation between those individual investors who have an advisor and those who don't. And so this was a little more granularity that we added this time to the study, where we said, how much of a difference does it make if you have an advisor? And so again, our sample had, about half with an advisor and half without. And you can see that's where the big gap is. If somebody has actually hired a financial advisor, they buy into the system, they think the system is trustworthy, and then they learn more about it through that process. So trust levels of those with an advisor are actually very similar to those that are institutional investors. One other thing, when we look at the system level challenges, we thought it was important to talk about retirement, since it's one of the top goals of most investors. And here we took the opportunity to ask the defined benefit participants in the institutional investor sample to say, how do you feel about expectations for the future? Do you think there's a possibility you will need to reduce benefits and payouts in the next decade? And here you can see that There's a lot of uncertainty. There's a lot of concern. You know, close to 50% said there is a good likelihood that we will need to do this. And so again, that gets back to this question of uncertainty. Is this something that is about trust in the financial industry? Maybe, maybe not, but this is something we will be dealing with, especially if we consider what the expectations are, right? A lot of times, of course, valuations are about comparison to expectations, right? And here we see that when we asked the beneficiaries, if you are eligible for a state-sponsored or government-sponsored benefit in old age, do you think it will pay out as promised? You see pretty high expectations, pretty high level of confidence there that it will. Maybe a little lower in the US and some other places, but again, still relatively high, high expectations. And we've suggested that this may be sort of accruing a trust deficit for the industry that we will need to deal with. So with that, let's switch gears to another polling question and see what you have to think about this. So you should be seeing this. Do you think clients are better or worse equipped with information about their investments compared with 3 years ago? So better, same, or worse? Again, this is a little longer time frame than we've done with our 2-year comparison, but how much information do people have? Okay, I think that's probably good. We'll end the polling. And all right, so looks like about 3/4 think it's better. So more information out there. What does that mean for trust? So Dan, over to you.
Yeah, so this one actually fell a lot closer to where I was hoping and thinking it might go. And by the way, many thanks to those of you that felt the need to kind of explain the answer on the first one. I guess I'm drawing a lot of love here. Few people had speculated as to why trust had dropped. So thank you. And I've tried to answer a few of you as I was listening. All right, so Rebecca, I'm not going to let you off the hook for just presenting here. I'm going to come right back at you and hard. You know, so this last section was on information. Is it possible to have too much information? Do we sometimes pump out too much in your mind?
Certainly. I mean, I think the question is that, you know, there's sort of data and then transforming it into information, right? What's actually useful for people. And one of the big ways that we break down trust is by thinking more information is always better, right? It's about getting the right information, about being clear, and, you know, industry jargon, sort of think, you know, what's your favorite type of industry jargon, right? You'd be amazed how much it really breaks down trust.
Yeah, it's great. In fact, Carol called me out on using too much jargon. Well, she didn't accuse me of it, but that was a point that he had made earlier. You know, so Patrizio, let me zip to you first this time, or not first, but let me go to you before Carol. You know, I just heard the D word out of Rebecca, data. You know, in your mind, do we rely enough on performance and that kind of statistical analysis to build, or as a proxy for trust? Or is it the right amount, or should we see more? You know, what does that reconcile the data we use and look at with trust in your mind? And that's an unfair question, but try to go after that a little bit.
No, I'll try. So you say performance in general. So look, so first I would say two things. Right? I think it's important to differentiate, as Rebecca did, right, between institutional investor and retail investor, because I think from an institutional perspective, we have the advantage, right, to have access to a lot of more information, right? We can access many asset managers. We can access our own network. We can access, you know, our own people. They have a certain level of sophistication to understand this performance and data, right? So from one side, we can utilize those data to make more informed decisions. When you talk about retail, in particular, Rebecca noticed in her statistic, retail without, right, financial advisor, is much more difficult to process all this data and information. So I think it's very important to differentiate, right, how you process all this data and information. I think performance, is performance the most important? No, absolutely. I don't think that's the case. That's not the thing that actually builds the trust. It may be the superficial way to judge at the beginning of a relationship or a partnership, right? performance means something that came up, right? But certainly over time, and connected to Carol's point, like over a long time, performance should not be the only way you build the trust, right? Trust is much more deeper than the performance and the data that you can generate. And I think there are good examples that I can use, right? One, obviously, the pension that Rebecca mentioned. So I'll put that as a side because it's an obvious known. But I think a place where data and performance and information about performance is critical, in my view, is again, be honest about the fact and the informations about the fact that investment returns are going to be lower. Investment now, they're potentially riskier, right? And to Carol's point, they're potentially more complex than ever before, right? So performance, right? Connecting the performance word is, well, the way you want to earn trust from, retail, asset manager is be honest about that conversation, right? The performance of the future or the present, they cannot be equally compared to the performance of the past. I'll tell you, like I work mostly of the asset that we manage are insurance, so I'll use insurance as an example, right? Insurance, I always say, is an industry that has been addicted, right? Our performance in general has been addicted to which part? To the income component, right, of the performance. Broadly speaking, high percentage of our portfolio, they are generally fixed income, generally high allocation to government and high rated bond, very often incentivized by regulator to do so, right? And so the question now is, unless you inform, right, your investor about the potential lower return and the potential higher risk that you face now, performance will be a surprise that will create, right, a loss of trust, right? When I think about what role, for example, again, and then I'll close there, like what role, government bonds play on an institutional portfolio right now. September was a good example. It's a short example of what could be in the future, right? All the market crash, right? Stock, maybe not crash, maybe it's too much of a word, but stock fell. And at the same time, treasury or the asset that we thought could be the hedge against stock fell. They didn't perform as people traditionally used to think will perform, right? Japan went through that in the 90s in terms of performance, in terms of correlation. And if you look places where rates were already very low, like Europe and Germany, this year, people should not be surprised by the fact that government bond will not hedge anymore the fall in stock. So anyway, long story short, right? We in US, we have to be transparent as a owner. We personally, we can do it. We spend a lot of time with our board to do so, to the fact that, performance, absolute performance cannot be just purely be compared to past performance, because performance, there are different angles. There is performance, there is the risk is going to be potentially higher, and most important, complexity of the investment we have to make, they're going to be much higher. And so information between asset manager, asset owner, and understand the complexity behind those instruments is way more important on gaining trust than the absolute performance per se.
I'm absolutely enjoying how you're weaving back and forth between kind of that, how we are as industry participants and your role as an asset owner. It's just almost very refreshing. Carol, if I could steer it to you, very similar question about the kind of volume and quality, but the one specific thing I have in mind, I mean, like, I really love having you here because I really kind of interested in your view, and I get a mini version of that myself, is when you think about all of the legal and regulatory information that we are required to share with prospects and clients. And I'm imagining in your role at MFS, we could probably fill its own room with that. I mean, I see it at BNY Mellon. Is there a risk specifically that because we have to force out so much like required, information, that when we really get to that kind of value-added information we share with prospects and clients, they conflate the two and think we're up to something? Is it, I'll just stop there and let you go with it if you don't.
Yeah, I mean, I agree on so many fronts, but I think I'm not surprised. Certainly access to information and transparency has improved. There's no question about it. But the danger that we're in right now, and this is what is breeding short-termism, is the massive amounts of it, right? And people expect us to help them weed through that. There's no question, whether it's at the stock selection or security selection side, all the way to the asset allocation, and all the way to just basic disclosure to retail investors. We have to cut through that. There was a great paper done by the Rotman School of Economics up in Toronto, and they really just talked about not only information being sludge, but they talk about cognitive overload, that both the retail and all the boards that we deliver this information to are being exasperated with cognitive overload. It hurts decision making. It hurts clarity. It hurts alignment. And so our job is to step into this, knowing that information is critical, right, for trust. So we can't do less of it, but it's our job to educate and translate. And I think, as we said, you always say, you know, you can't manage what you can't measure, but we now need to tell our clients, the people we work with, is what you measure matters a ton. And when you're delegating your precious money to somebody else to manage on your behalf, you're hiring them to do three things in our industry. To be stewards of your capital. How are you putting my money to work responsibly? Prove that to me. Help me understand that. The future is not going to be how much money you make for me. It's going to be how you make it. So prove that you're putting my capital work, the capital that I've bestowed on your behalf, to prove that you are a steward of my capital. The second is, tell me how you're managing my risk. I'm really delegating risk to you, and show me that you're doing that, and then ultimately returns. But I think in that order, and it actually proves back to, I was looking at, Rebecca, the information you showed, you know, it's the most important piece. Show me that you're got my interest at heart. And my interest at heart isn't just about my bank account. Yes, it is. But really at the end of the day, if you tell them actually that we're all connected to this capital market, and how we all allocate that capital responsibility is dependent on us doing a better job translating massive amounts of information. And this is the huge opportunity for us as an industry. It's exciting because not only do we have more information to be transparent, but now we can really step in and continue to help investors become better investors.
Really, I love that. I wrote down cognitive overload and a few other things. Carol, just kind of having gotten to know you and Patrizio, one thing that's occurred to me on this kind of line of thinking, specifically on information, is I have a really dear and long-term client, comes from a well-known family, and I was walking through a strategy in really granular detail, and at one point she stopped me and said, you know, the more you talk, it's almost like the guiltier you sound. You know, that I just felt like, you know, like I just
More.
at that point, you know, and to your point, I mean, when you said cognitive overload, I was like, you know, like I think I just kind of tripped the wire there. So I take your point that, you know, it's being kind of effective and efficient and targeted, knowing my audience and getting that message out there in a very kind of packaged and thoughtful and authentic way. I mean, I think that helps to build the trust, right? Which is why we're here. So,
Dan, can I just add a quick story, because Patrizio, the way he outlined it, just reminded me of in my early days of my career. I was on the 401k side, and so I did tons and tons of enrollment meetings. And I'll never forget, one of the number one questions I would get from the audience, you know, when I explained the long menu of choice, they'd say, Carol, how much risk should I take? And I only had a question. I didn't have an answer back. I had a question back, and it was a simple one. And that's, how much time do you have? Because it's so easy to decide we can tell somebody how much risk, but unless they tell us how much time they have, there's no alignment.
Yeah, excellent point. That's good. All right, I'm taking another note, but I'm going to kick it back to Rebecca now. So we have time for one more of really these tenets. I know that you have two that you had in mind. I'm going to let you, we'll call it dealer's choice, Rebecca. You want to take us, and then we'll finish. We'll do a little more Q&A after that, and we'll call that a wrap. So please.
Yeah. Well, this is actually my favorite section, the one around innovation and technology. So let's just spend a couple minutes there to wrap it up. And so, of course, technology has been transforming a lot in our industry. And so the key question is, what does it mean for trust? And at the highest level, we do find a positive relationship to trust. So we essentially said, how has the impact of increased technology by your investment provider, how has that impacted trust? And so you can see in the purple there, especially on the institutional investor side, there's a lot greater trust because of that technology, the good use of it. It is that transparency, but then it's also, I think, interesting because they are recognizing what to do with that, right? So perhaps that's a reason why that purple bar is bigger on the institutional side than on the retail side. So again, some will say no change. Actually, in the U.S., it's about 70% on the retail side that say no change. So I think we've gotten up that curve to a large degree in terms of how much technology impacts things in a positive way as far as trust. So that's the relationship between the two. And then I'll note that this line of discussion started, in our 2016 study. We said, let's have a little bit of a provocative question where we said, which is most important to you, technology or people, right? And really here we said, looking out 3 years, this is to the individual investor audience, the retail investor, do you think it's more important for you to have access to the latest technology platforms, that's the blue, in order to execute your retail strategy, or is it more important to have a person to help you navigate the markets? And so, of course, you can see here a major difference around the world, right? And a lot on, very tech-centric in India, China, again, maybe more developing markets, but then you see the US is still very human-centric at the other end. So a lot of people want help. They want that, it's not just an either or for everyone, right? Now, I will note that from 2016 to 2018, we just saw a steady increase in technology. People wanted more. It didn't matter where you lived. It didn't matter how old you were. But now we're starting to see a little bit of a tapering off, some nuances there. So essentially, the younger investors still want more, but those that are sort of middle or later in their investing career or investing time horizon, are sort of saying, well, tell me why I need more and is it useful? So you actually see the preference for technology has decreased in the last couple of years in places like mainland China, Hong Kong, Singapore, the US, France, and Brazil. So a little bit more of a mixed bag, a little more nuanced. And then this kind of reinforces the point, though, that we have been making for a while, that you kind of want the best of both worlds. So here we talk about artificial intelligence and human intelligence as the way to optimize. And so we asked first on the artificial intelligence side, would you like to invest in a strategy that uses AI to select investment holdings? And strong interest from the institutional side, 70% say yes. On the retail side, much more mixed. A lot of people uncertain on that. Only about 20% of those in the US said, yes, I'd be interested in an AI-driven product. But then there's the human intelligence side. And that's really when you say the word advice, people want a person, right? And especially as you see more uncertainty, you want a person, right? And how many of you have gotten into, the unending loop of trying to find a customer service person for some other industry, right? You want a person when it comes to your financial future. So take the best of both. That's our advice. And then on the, if we talk about innovation more broadly, one of the other things we found interesting was we asked, would you be interested in being an early adopter of new products? And we found there was a big difference between those with an advisor and those without an advisor. So perhaps not surprisingly, those who have an advisor are more likely to try new things. And so again, this is kind of nice proof that if you're going to diversify your portfolio, if you're going to go into maybe a more challenging market and say, I need to do something a little differently, having an advisor can really pay off. So you can also see that the younger you are, the more likely you are to want to try new things. And lastly, in this section, this is what I like to call the Google question. So we asked the early adopter institutional investors, if you get one of these new products, where would you like to get it from? Do you want it from a financial institution or from big tech, right? Tech was the most trusted, one of the most trusted industries. And we specifically said in the survey, you know, like Amazon or Google or Alibaba. And you can see it was a pretty much a 50-50 split. So I think that sort of puts the pressure on the industry to keep innovating. There may be a little bit of ambivalence about where that innovation comes from. And we need to show that using economic intuition and combining it with technology well builds the most trust. So with that, I think we're going to do our last polling question. So I think you should have that in front of you now. So around technology in particular, we know there's lots more technology spend happening. Where do you think the incremental technology spend of the industry would be best spent to increase trust? Cybersecurity, AI or machine learning, client tools and the interface, or process efficiency in order to lower trust? So give you a second to think about that one. And then Dan can take us home. Let's say maybe last chance here. We close it out. So looks like client tools and interface came out.
Wow. You know, we have a great audience here. I could have sworn people were going to go for the kind of sexy and glitzy AI and ML. Yeah. But no, I mean, I guess we've got a super high IQ and you know, very kind of emotionally intelligent audience. So that's great. Thanks, Rebecca. Rebecca, again, I want to kind of go to Carol and Patricio here, but first I'm going to kind of attack you a bit. It's why we're so good. It's why we're going to hopefully remain good friends. All right. So earlier we saw kind of technology take a little bit of a hit in terms of kind of trust, and not surprising. You take a look at the last few years, you know. So reconcile for me why we believe respondents to this survey who are technologically inclined tend to have more trust for the industry. You know, like, is that just kind of another shoe to drop, or in your mind? And listen, I'm not sure there's an answer out there. If you have it, give it to me, but you're so close to this. Have you given any thought to that?
Yeah, well, I think that, I think trust is, there are some people that are more trusting than others, right? And so sometimes it carries across, right? And so one of the questions we asked also was, how trusting are you of your personal data online compared to a few years ago? And I'll tell you, at least in the US, that was the market where people were most worried about the security of their data and how it would be used going forward. So I think that's one of the reasons you might see a little bit of a decline in technology trust overall. But counter that with the fact that the age group overall that is most trusting of every industry, including finance, are the youngest investors. So millennials trust finance more than any other age group does. So my question is, how do we keep that, right? It's about the long term, right? We've talked about that. So we've got the potential now to take this cohort and say, okay, there are going to be ups and downs in the market. There will be uncertainty, but you can trust that we know how to navigate it, and we're going to take you along with us, right? And make it more of a partnership. So.
Great, good answer. And I'm glad you didn't flip the tables on me and get me to try to answer, because I would have had none. So thank you. You know, Carol, if it's okay, maybe I'll start with you this time. And you know, when I guess I can only imagine the investment that MFS has made a lot in kind of technology, capital T, but really thinking about kind of the client experience, thinking about, you know, process improvement, thinking about probably how you're arming your fund managers and the tools and the data. You know, if you try to equate that to kind of the trust equation and strengthening that, you know, or closing the gap and strengthening it, you know, has it been money well spent? you know, do you have a kind of larger vision around innovation and the client experience and trust? I mean, because you really sit in a unique perch, you know, so, I mean, part of me hopes I'm catching you off guard here a little bit so I can get the kind of real, you know, give it to me, but think about that and try to reconcile that a little bit for me.
Yeah, I think it's just, you know, not only is it absolutely critical in terms of how we're allocating our own capital around technology, it is an intense balance, right? Because it's improving your investment platform and ensuring that you are getting to the best information in the world and that you're able to, right? Technology has completely disrupted active management. And, you know, we know that in our heart, but what we see with technology gives us then an analysis advantage from the human aspect of how we then, as Rebecca says, take that information and turn it into real value. But the cybersecurity and the client engagement and delivery and interface, it is absolutely critical that there's equal weight there, because, you know, the biggest risk in our industry, and a big consulting firm said it, that so many other industries have been hit hard by a breach in security of their data. And most of it has been either in the retail markets or the retail industry. It hasn't quite, at a major magnitude, hit the financial services industry. But if it does, all bets are off. And so we have to think about every moment of being ahead of what could breach any client data or information. So that is critically important. And then I think we've all talked about it. Our role is to translate all the noise and educate and help our clients become better investors. And so how do we do that? Technology is going to be critically important to doing that. We think advice gets so much more important in the future. I have a 28-year-old and a 25-year-old, and I'm telling you, they actually trust the financial system, but they want help, and they say it, you know, and they're actually fairly enthusiastic about getting help that's not directly from technology. So, and that's surprising to me, actually.
So I don't want to, we've been kind of going for an hour, and I'm going to finish with a question or two to Patrizio, but I have one follow-up question. We'll see if I can catch you in a weakened state. I mean, listen, MFS is kind of a juggernaut and a stalwart, not just here in Boston, an engine for our industry, but really globally. If I were to say, where are you going to kind of allocate your technology dollars over the next, say, 3 to 5 years? Can you give me any inclination of where, you know, you see, you know, and as it relates particularly to client trust, is it more on the kind of fund management side, the processing side, the client experience side? I mean, you're not going
to like the answer, Dan. It's all of the above.
I love that answer.
It is all of the above. We cannot be asleep at the switch on any of this. You know, we're going to celebrate 100 years in 3 years, you know, and committed to active management. But the industry and customers change, and we have to adapt along the way and invest in the technology platform to get us there. So
do us a favor. I'm going to have at your 100-year anniversary, make sure you tell our good friend Mike Roberge he looks good for 100 years old, will you?
Sure will.
Patrizio, question for you, and I want you to kind of take off your asset owner hat and put on your asset liability insurance company hat and think about the trust you've built and maintained for your clients. You know, have we spent enough on innovation? Are we giving them the kind of best we can to build that trust, to build that kind of reliance on the advice you give? I mean, and listen, you're an academic. You know what you're talking about here. You know, you're not, you know, share with me the investment and think about the industry. This isn't kind of, you know, this isn't kind of firm specific stuff. Can we do more? Have we done a good job earning the trust of our institutional clients? You know, take us through that a little bit.
Yeah, I mean, it's a good question in the sense that, look, I think the key here is, I think connection is, innovation is what it matters, right? So have we done enough, at least in the insurance industry, to, you know, to manage the mechanic of technology on how you manage asset liability and all that nice stuff yes, we did, right? The problem is, again, go back to some of the how we can additionally earn trust, right, between the business and as asset manager, between asset manager, asset owner, is, we have to continue on that evolution and that innovation of technology. Personally, I was a little bit surprised by the answer, right, that we got in the poll. But then I was thinking back for a second, and I was thinking, well, the question is specifically about trust, right? It's not about where we need to improve our technology, right? It's not cybersecurity. Do we need to spend more? Yes, for sure. Artificial intelligence, yes, an opportunity. But specifically, the question was about trust. And to me, when I saw the poll results, is in certain sense, the answer connect exactly to kind of what the study that Rebecca is presenting, because the two things that basically you are amplifying is information, right? And the ability for the client to express, right, in certain sense, their view, right? Be more participant to the investment process and the decision process. So, I mean, I don't know if I specifically answer your question. There is a lot there. And then I can probably go on for much longer, but I want to be conscious of time. I want to only make one more comment. Again, a connection between what you ask and also some of the polling, right? It's interesting when I see the result of the study and say that pretty much most of the institutional investors, but also retail, they are looking for additional technology, right? For enhancing their investment decision process and so on, right? There is an overwhelming direction. Everyone answered, yes, I want more technology. But then it's very interesting when you have, so there was a question say like, if you have one of the two choice, right, between having, the technology making the decision for you, or you would rather to have, having a person to help navigate what is best for you. At least in US, 70% of the responded answer having a person. And so I connect that with your question about asset liability and what matters for insurance and for asset manager of insurance company is, look, the technology is extremely important to inform the decision, right? But technology cannot in isolation make decision for us, right? It's the human intelligence behind asset liability management, risk management, asset allocation, strategy decision that can actually ultimately make the decision. Technology will never make the decision for us, right? And the more the complex the problem is, the more you need the interaction between human and technology to make the decision itself.
Let me just, I'd almost want to say, Patrizio, don't say another word, because I'm reminded that humans build the technology and humans interpret the output. It's just powerful stuff. And I couldn't agree more. So just a couple of words to kind of close out here. I said 115, we actually budgeted to 130 and it's now 123. So we kind of split the difference. Just a few quick observations. I want to start off by thanking Rebecca, Carol, Patrizio for joining us. The questions are actually building a little bit of momentum here. I've got a couple coming straight through, and I'll just kind of share them, not in the way of a question, but an observation. Someone highlighting, and Carol, this wasn't aimed at you, but really a call to arms that individuals, the people, are what kind of builds the trust. We need your kind of leadership, that kind of statement to really help, set the tone for all of us, that tone at the top. So you're getting some kind of love right out of a question here on two different questions. So I want to make sure I say that to you and for the benefit of everyone here. Someone else did remind us too that your focus on time horizon really great, and is also one of the other key elements to how we form our IPSs, right?
Absolutely. I love that point, actually. And of course, it's more complicated than just how much time you have. I loved the fact that absolutely liquidity and taxes and definitely unique circumstances. I couldn't agree more.
Yes, so there's a home for you in wealth management. If you ever want to hang it up in executive leadership, I'll tell you that. So, again, want to thank the folks for joining us. Virtual has really allowed us the ability to come together in a way, and I'm glad that Gary at the CFA Boston office was able to kind of get us organized, pull it all together. I love that we're doing this intimate yet really kind of intense. And just want to say that selfishly, Rebecca, a longtime friend, respect her intellect, and thank you for all your work. And from my heart of hearts, I feel like I have two new friends, which are really important. A lot of times people ask me what's in it for you in this stuff, and meeting people like you, Carol, and you, Patricio, is what stirs the drink for me. You know, it just kind of keeps it going. So thank you very much.
Same here.
Absolutely. And for everyone that called in, thank you so much for giving us your time. Keep the questions coming. We love your membership. And for everyone here, enjoy the rest of your day. Take good care. We'll see you soon.
Thanks, everyone. Dan,
Thanks.
Rebecca, thanks so much for coordinating. And Gary, too.
Yep.
Bye.
Thank you all.
Pleasure.
Good to